Welcome to Opalesque 5 Minutes. I am in Las Vegas and have the pleasure to be with Frank Meyer. Frank Meyer is obviously, as you know, one of the veterans of the hedge fund and fund-to-fund industry, and back in 1990 he made a huge bet on Ken Griffin, which obviously worked out very well. Frank, tell us a bit about your background. How did you get interested in hedge funds in the first place?
I was working for an entity called A.G. Becker. A.G. Becker was one of the biggest dealers in commercial paper, second to Goldman Sachs. But in addition to being a commercial paper dealer, they also had a service that measured the investment performance of pension plans. Typically, they were evaluating traditional managers and comparing them to each other. And while I was working on that service, I looked at some of the other clients A.G. Becker had, individuals. They were invested in hedge funds. And these hedge funds were really interesting. You know, the performance was a little better, but most importantly, there was very little correlation with the traditional equity managers that our large pension clients were taking. And so that just intrigued me. So I went, I learned more about them, and then in 1973, I teamed up with another partner and became active in the fund-of-funds business.
How has the fund-of-funds business changed since 1973? Can you tell us, let's say, just three big major changes?
Well, the first major change is that it was addressed completely to individuals, not fiduciaries, not pension funds or endowments. And the reason is that in 1973, the prudent man rule had not changed. The prudent man rule was a rule that said that you had to, as a fiduciary, you had to look at every single investment individually and say it was prudent. So if you were doing, say, convertible bond hedging, where you were long a convertible bond and short the common stock, one of those investments was by definition imprudent. In other words, prudence was judged on an individual asset basis, not a portfolio basis. And so that eliminated a lot of investors in the institutional world. Second major difference was openness. Every manager would show you his portfolio, would tell you all of his shorts, because typically the managers were small, and they hoped that if they told you about the shorts that you'd spread the word and then the stocks would go down. Now managers are very secretive about their portfolios. Third, you had much more time to learn about a manager before you invested. Typically you meet a manager and then maybe several months later, you've been on his mailing list and you go see him again. Then maybe you would give him a tiny little amount, and it might be 2 to 3 years before you'd have a full position. So those are three major differences that are very striking when you compare with the world today.
You are observing the industry since 1973. Is there anything particular or any developments that you are proud of or that you are excited about at the moment?
Well, I'm proud of the fact that institutions are investing, that the portfolio approach to investing was accepted. I'm proud of the fact that whereas initially everybody said, oh, hedge funds, risky, now people recognize that they aren't necessarily more risky than traditional investing, where you can easily, suffer a huge dive in the market. I'm proud too that it's become a business. When I was out there initially, I had to convince people that it was a business, and now, as you can see, by thousands of funds and thousands of fund-of-funds, and this is a real industry. And I'm proud that I'm part of that.
In 1990, maybe even earlier, you discovered or got to know Ken Griffin. What is it that you think seeders or people that are early stage investors should look out for when looking at a new upcoming manager?
I think you have to look at the manager and see, what are his strengths, what are his weaknesses, and to the extent that he has weaknesses, and all of them do, how is he going to compensate for the weakness? I mean, basically, when you're a money manager and you're leaving working for someone else and going on your own, you have to manage a portfolio, but you also have to manage a business. So I think it's important that you see a manager that shows breadth, that he respects the parts of the business that he doesn't know that well as the parts of the business that he does know.
My last question, Frank, is what are the areas where you see at the moment opportunities in the industries?
I think there are huge opportunities. You have to really look at the opportunities in the world today and how the world is changing. And one of the things you see is that taxes are going to go through the roof. Countries have huge deficits, and to the extent that individuals invest in hedge funds, I think there's a real opportunity for managers to specifically identify their after-tax returns, and if they can demonstrate that they're minimizing the tax consequences and maximizing the after-tax returns, I think that's a real opportunity. In other words, a series of funds that focuses on taxable individuals. What's happened now is with so many pension funds and endowments and foundations that don't pay tax, the concentration is there and tax efficiency is minimized. That's one major area. The second major opportunity is to become more institutional in the business side of things. It used to be that every investor had total control of his assets through separate accounts. The manager had a contract to manage the money. All he could do was buy and sell. The valuations were determined by the client's custodian. There were a lot more protections than you currently have in commingled vehicles. I think that there's a real opportunity to change the commingled vehicle structure so that it has and offers more of the protections that investors traditionally had. Important is to look ahead at the future. When people look at the past, when they look at the past in terms of returns, or when they look at the past in terms of risk, they make a big mistake. I mean, take risk. To look at the past in terms of risk is like saying, well, it's like BP saying, well, we've done a lot of offshore drilling and, we haven't had many spills because we're very careful and conscious. What's important is not to look at the past, but to look at the future and talk to people. What are you worried about? What concerns do you have? What are you trying to protect against? That's one major thing. A second major thing is to really focus on what risk really is. A lot of people look at risk as something quantitative, and they base their analysis of risk on what's happened in the past. What you really have to do is look at the future. I mean, if a drunk walks along the side of a cliff and doesn't fall over, he's conservative by most measures. Risk is exposure to an unfavorable outcome, and it can only be judged in a future sense, not in a past sense. This is one reason I've always been able to invest with managers early on, because I don't let track records overwhelm me. Track record is what was earned on someone else's money previously, and I think all investors should focus on what's going to be earned on their money prospectively.
Right now, right?
Yes.